Welcome to Wall Street. What is the stock market? Think of the stock market like a giant farmer's market, but instead of fruits and vegetables, you're buying and selling pieces of companies. These pieces are called stocks. The stock market is simply a place where these trades happen every single day. It connects buyers and sellers, creating a bustling marketplace for company ownership. The stock market is very important for our economy. It's where companies raise money to grow their businesses. They do this by selling stocks, giving investors like you a chance to share in their success. Whether you're a seasoned investor or just starting out, understanding the stock market is crucial for building wealth. It's your gateway to participating in the growth of companies you believe in and securing your financial future. So, are you ready to learn more? Let's dive in. Owning a piece of the pie, understanding stocks. Imagine owning a tiny slice of your favorite company, like Apple or Amazon. That's what a stock is, a small piece of ownership in a publicly traded company. When you buy stock, you become a shareholder, which means you own a part of the company. Companies issue stocks to raise money for expansion, research, or to pay off debts. When you buy a stock, you're giving the company money in exchange for a share of its potential profits. The value of a stock can go up or down depending on how well the company is doing and other factors in the market. If the company performs well, your stock value increases, and you can sell it for a profit. On the other hand, if the company struggles, the stock value may decline. Investing in stocks allows you to participate in the growth of companies you believe in and potentially see your money grow over time. It's an exciting way to build wealth and secure your financial future. The trading floor. How does the stock market work? Imagine a giant auction happening electronically, 24/7. That's essentially the stock market. Buyers and sellers from around the world place orders to buy or sell stocks through a stock exchange like the New York Stock Exchange, NYSE, or NASDAQ. These exchanges act as marketplaces, connecting buyers and sellers and ensuring fair and orderly trading. When you want to buy a stock, your order is matched with a seller offering that stock at the same price. Similarly, when you want to sell, your order is matched with a buyer. The price of a stock fluctuates throughout the trading day based on supply and demand. If there are more buyers than sellers, the price goes up. Conversely, if there are more sellers than buyers, the price goes down. It's important to note that the stock market is influenced by many factors, including economic news, company performance, interest rates, and investor sentiment. These factors create price fluctuations, making the market dynamic and sometimes unpredictable. Your first steps. Getting started in the stock market. Ready to dip your toes into the exciting world of investing? Getting started in the stock market is easier than you might think. First, you'll need to open a brokerage account. Think of this as your gateway to the stock market. You can choose from online brokerages, which offer low fees and user-friendly platforms, or full-service brokerages, which provide personalized advice and a wider range of services. Once you've chosen a brokerage, you'll need to fund your account. This means depositing money that you're ready to invest. Now comes the fun part, choosing your investments. You can buy individual stocks, which means owning shares of specific companies, or you can invest in mutual funds or exchange-traded funds, ETFs, which are baskets of stocks that track a particular index or sector. When placing an order, you can choose a market order, which buys or sells the stock at the current market price, or a limit order, which allows you to set a specific price at which you're willing to buy or sell. Congratulations! You're now officially a stock market investor. Remember, start small, learn as you go, and don't be afraid to ask questions along the way. Welcome to Section 5, the roller coaster ride, risks and rewards of investing. Now, investing in the stock market is, well, kind of like riding a roller coaster. There will be ups and downs along the way. Understanding the risks and rewards is crucial for making informed investment decisions. Let's start with the risks. The stock market is inherently volatile, meaning prices can fluctuate significantly in the short term. Economic downturns, geopolitical events, or company-specific news can all impact stock prices, leading to potential losses. It's important to remember that investing in stocks always carries the risk of losing some or all of your investment. However, it's equally important to remember that the stock market has historically trended upwards over the long term. Now for the rewards. Investing in stocks offers the potential for significant growth. When you invest in companies that perform well, their stock value increases, leading to capital appreciation. Additionally, many companies pay dividends, which are a portion of their profits distributed to shareholders. Over the long term, stocks have historically outperformed other asset classes like bonds or cash, making them an attractive option for building wealth. Picking your winner's tips for choosing stocks. Choosing the right stocks to invest in can seem daunting, but it doesn't have to be. Here are some tips to help you make informed decisions. First, do your research. Before investing in any company, take the time to understand their business, financials, and industry. Look at their revenue growth, profitability, debt levels, and management team. Next, consider your risk tolerance. Different stocks carry different levels of risk. Growth stocks, for example, offer high growth potential but also come with higher volatility. Value stocks, on the other hand, are considered less risky but may offer slower growth. Think long-term. Don't get caught up in short-term market fluctuations. Instead, focus on companies with strong fundamentals and a solid track record that you believe will continue to perform well over the long term. And finally, seek professional advice. If you're unsure where to start or feel overwhelmed, consider consulting with a financial advisor. They can provide personalized recommendations based on your financial goals, risk tolerance, and investment timeline. Remember, there is no guaranteed formula for picking winning stocks. However, by doing your research, understanding your risk tolerance, and thinking long-term, you can increase your chances of making profitable investments. Don't put all your eggs in one basket. The power of diversification. Imagine putting all your money into a single stock. If that stock performs poorly, you risk losing a significant portion of your investment. That's where diversification comes in. Diversification means spreading your investments across different asset classes, industries, and geographic regions. By diversifying your portfolio, you reduce the impact of any single investment on your overall returns. Think of it like this. If one stock in your portfolio goes down, others may go up, offsetting your losses. Diversification helps to mitigate risk and create a more stable investment portfolio. There are several ways to diversify your portfolio. You can invest in a mix of stocks, bonds, and real estate. Within stocks, you can diversify across different sectors such as technology, healthcare, and consumer goods. You can also diversify geographically by investing in international stock. The key to effective diversification is finding the right balance between risk and return that aligns with your financial goals and risk tolerance. Slow and steady wins the race. Long-term planning for success. Investing in the stock market is a marathon, not a sprint. It's important to approach investing with a long-term mindset and avoid making impulsive decisions based on short-term market fluctuations. When you invest for the long term, you give your investments time to ride out market volatility and benefit from compound growth. Compounding is the snowball effect of earning returns on your initial investment as well as on any accumulated earnings. Over time, even small amounts of money invested regularly can grow significantly. Patience is key in the stock market. Don't panic sell when the market dips. Instead, view market downturns as opportunities to buy quality stocks at discounted prices. Remember, the stock market has historically trended upwards over the long term. By staying invested and remaining patient, you increase your chances of achieving your financial goals. Start your investing journey today. Congratulations! You've now completed our crash course on Stock Market 101. You've learned what the stock market is, how it works, and the steps to get started. You've also gained valuable insights into the risks and rewards of investing, tips for choosing stocks, the importance of diversification, and the power of long-term planning. Remember, investing in the stock market is a journey, not a destination. It's about making informed decisions, staying disciplined, and remaining patient. Start small, invest consistently, and don't be afraid to seek professional advice when needed. The world of investing awaits. Take the first step today and watch your financial future blossom.